idea, and we'll keep going back over this, how there is an advantage to the lessee to avoid lease capitalization. Now, we're going to look at the conditions and show you how they could avoid it. Depending on the contract, they may be able to avoid it. In some cases, there might be obviously some give and take between the lessor and the lessee. We'll talk about that as well. We had somebody preempted a question in the other class, or preempted a topic. Well, maybe I'll just ask you now. From the standpoint of the lessor, do they prefer capital or operating leases? And before you think about that, let me just give you some brief background. If you're the lessor and you have an operating lease, what do you have? Debit, cash, credit, rental income. The asset stays on your books, right? Whatever asset you have. The reason for it is because you didn't sell anything. If you go to the capital lease side, think about this for a second. If the lessee is buying the asset, you have to be selling it. So if you're selling the asset, you're going to have the asset removed from your books, and you're going to replace it with a receivable. Now, the people that are leasing are going to be large insurance companies like Prudential, investment banks like Morgan Stanley, commercial banks like Deutsche Bank, or JP Morgan Chase. What do they want on their books? A fleet of jets, trucks, ocean-going vessels, or finance receivables? They want a finance receivable. So the lessor is more concerned with getting capital leases, whereas the lessee is more concerned in getting an operating lease. And contracts can be developed where you can get both. Now, here's the real interesting thing when this happens. And I'm going to zero in on this. You're going to see this as clear as day when we get to the numbers. But here's the deal. I mean, if I structure a lease that way, what happens? You bought the asset, I sold the asset, you didn't buy it. Where did it go? Disappears. Right? You have an operating lease, you're a lessee, you just have rent expense. You don't put the asset on your books. I have the asset, sold, it's off my books now, gone. Nobody's got the asset. Disappears. There could be cases where both of us have the asset. I'm going to ask that question when we get to those sections, but does it bother you to have asymmetric accounting treatment? There was a time in accounting where we tried to have a parallel accounting. So we thought that in a global macro sense, if you have a sale, I should have a purchase. Sort of makes sense. Today we're getting away from that. We're not worried as much about that. In fact, the new standard may even exacerbate having assets missing or two people holding the same asset. Now, I can tell you the reason, but we'll do that when we have a discussion. So I don't know how you feel about that. I'm still not quite sure what the best way to go is. But just note for now that the lessee prefers operating. The lessor would generally prefer a capital lease. Okay. Now, a couple more things to think about. Oops, make sure I don't knock this off before we get into the standards. Well, I want to make sure before we go into the standards that we understand a couple of these concepts. We already know what the executory costs are. These are maintenance, insurance, and taxes. The minimum lease payments, as I said, have to be exclusive or cannot include executory costs. So what are the minimum lease payments? The minimum lease payments are made up of four components. It'll be minimum rentals. Those are the pure rentals, as I tell you. The pure rentals that do not include executory costs. A guaranteed residual, which will be the amount of the asset's value at the end of the lease. This will either be guaranteed by the lessee, as you see here, or it'll be guaranteed by a third party. Now, this is interesting, and this is how you can get that asymmetric treatment, which I'll go over again. But I mentioned this in the other class. Speaking to someone in CFO of a major capital company said that this is done all the time. What you can do is to lower the minimum lease payments, and someone talked about in the other class about trading off, and we did just now, trading off residuals for payments. If I need to lower the payments, I could pay someone to insure, get an insurance policy to guarantee the residual. So you don't have to worry about it as the lessee, and the lessor has someone else guarantee it. We will get back to that, but just realize that the guaranteed residual value could be guaranteed by the lessee or a third party. So when we talk about the asset having to be valued at the present value of the minimum lease payments, the minimum lease payments or minimum rentals, and again, you have to exclude executory costs. Plus a guaranteed residual value, and also, let me go back here, could also have a bargain purchase option which is an option, as we said earlier, in the lease terms to buy the asset at a price that you know is substantially below the fair value. And also if there are penalties for failure to renew. And we're not going to discuss that. So we're going to cover, when we look at minimum lease payments, we're going to look at minimum rentals, bargain purchase options, and the guaranteed residual value. Now, where you're going to get more and more differences between the lessor and the lessee, well, here's just one example. What if there's a guaranteed residual by a third party? Your minimum lease payments will be different than the lessor's. So you could get substantial differences there. But for now, when you look at minimum lease payments, the minimum rentals have to exclude executory costs. So maintenance, insurance, and taxes have to be excluded. You also have to have the guaranteed residual. As I said, we're not going to worry about the penalty for failure to renew. And the bargain purchase option will also be part of our guaranteed residual, of our minimum lease payments. Okay, so the executory costs will be part of our minimum lease payments. Now, we said the asset will be valued at the present value of the minimum lease payments or the fair value, whichever is lower. In order to discount those minimum lease payments, we need a discount rate. The discount rate, if you go to page 5, is going to be the incremental borrowing rate, which is the rate that the lessee would incur if they borrowed on a loan. So essentially, applying this to a personal case, if you lease a car versus buying it, if you bought the car, what would the bank or the finance arm of the dealership charge you to buy the car? What would be the interest rate? That would be your incremental borrowing rate. It could also be your cost of capital or your weighted average cost of debt capital. So it's the rate that you would incur on a similar transaction if you were going to buy the asset. Now, there is an exception, and that is if you know the rate implicit in the lease. So one of the things you'll see, and you don't always know the rate implicit in the lease. Take a look at lease contracts. They may not specify the interest rate. There's so many things going on in the lease. You've got the cost, the gross profit, and the interest. And sometimes the dealer might say, all right, I'll give you the car for less money. But what you don't realize maybe is that you're paying more interest on the lease. So sometimes it's not transparent. So that when you look at your discount rate, it's got to be the lower of the incremental borrowing rate. Or lessor's implicit rate. If known. There's a couple of reasons why we use the lower rate. And I think I mentioned this last semester. Anytime you see that GAAP sets up these barriers and rules and all this other stuff that really makes our head spin, there's a reason for it. And in this case, the lower rate results in a higher present value, right? So the lower rate gives you a higher PV, avoids understating the liability. Now that's there's a couple of other reasons for it too, but the FASB thought that if I gave you a choice, if I give you the choice and you pick the higher rate lowers the PV and it could understate the liability. So from the standpoint of conservatism, the lower rate increases the present value and avoids understating the lease liability. There's a couple of other reasons for it as well. IFRS is much easier, which we'll see. IFRS just says, look, always use the implicit rate, and if you can't find it out, use the incremental borrowing rate. That's it. IFRS is much easier, and we're going in that direction as well. All right, so that's basically the background. The key concept, again, is economic substance over legal form. Now, how do you operationalize this? So, in other words, when we look at this theory, how do we operationalize it? Well, under U.S. GAAP, we have separate conditions for the lessor and the lessee, whereas under IFRS we don't. But let's start with the U.S. GAAP conditions. And these are 4 criteria for capitalization. If you meet any one of the 4, it is a capital lease. So that if we go back here and we look at the conditions, to operationalize this theory, meet any one of 4, operating lease, none of the conditions are met. Okay, so if you meet any one of the 4 conditions, and this is for the lessee, only, lessor has a separate set of conditions. If you meet any one of the 4, it is a capital lease. It's on the balance sheet using the capitalization method. If you don't meet any, it is an operating lease. And let's look at the conditions. The first 2, I think, are obvious: transfer of ownership and a bargain purchase option. If at the end of the lease you're told that the car is yours, or you could buy it for $100, you could buy it for $2, you have built up equity. So what this implies is that the lease payments have built a material, I'll bring this up on the screen for you, have built up a material equity in the property. So it's essentially like buying the asset. So it's the same thing as making a loan payment. So I think these two are obvious, right? So if at the end of the lease I give you the asset, you paid for it. If at the end of the lease you could buy it for $1, you already paid for it. So it's the same as buying the asset on long-term debt. Now, if you don't want to have the lease on your balance sheet, just make sure those conditions are not in the contract. And once again, it is negotiations between the lessor and the lessee that could determine the actual contract structure. Now, these are pretty clear. The next two will give you a lot more flexibility, and that's the 75% test and the 90% test. The 75% test, let me just put it over here. Says that if the lease term, that's the total, is at least 75% or more of the economic life of the asset, it is a capital lease. Now remember, I'm going to go back, and I always circle back, always hit the theory again to pick up the pieces. What's the total lease term? It's the initial term plus what? A bargain renewal option. So that the initial term plus the bargain renewal option, if that's 75% or more of the economic life of the asset, it's got to be a capital lease. Now, how do you avoid that? Could fudge the life of the asset, right? I mean, there's some judgment in there. And plus, you could just make sure you don't have a bargain renewal, or you make the lease term short enough. Now, the argument, of course, is, or the rule has to be supported by theory. So going back to the theory, we're basically saying that if you hold the asset for 75% of its life, you're definitely capturing most of its, substantially all of its rewards, and absorbing substantially all of the risks of ownership, right? I mean, if you hold just take an auto lease. I mean, that's kind of like holding the car for 7.5 years. I mean, you've pretty much used up most of its capacity, and over a 7.5-year period for an auto, you've also obviously absorbed a lot of the risk of obsolescence, because cars and technology have changed so rapidly that you're now holding a car that's 7.5 years old. Give it back to the dealer's already probably captured most of the value of the asset. So in a way, and although the risk of obsolescence is now passed along to the dealer, you've absorbed most of it over that period. You've consumed most of the asset. Under the new standard that they're proposing, the idea of asset consumption is going to be key. If you're consuming most of the asset, you've got to put it on your books, pretty much. Yeah. Oh, it's the initial term plus the bargain renewal option. Initial term plus bargain renewal. Okay. So again, and by the way, if the asset is a used asset, you can't capitalize it under these 75 or 90 because you're not going to hold it long enough to have what? The risks and rewards of ownership. You're not going to have it long enough. Now, the 90% test essentially says that present value of the minimum lease payments, which of course exclude executory costs, is at least 90% of the fair value of the asset. At least 90% of the fair value of the asset. Now again, this is sometimes known as the 90% test or investment recovery. This should really be 100%. If you think about the value of an asset, the value of any asset economically is what? The sum of the present values of its future cash flows. So that should be 100, but the reason why we don't use 100 is because we're uncertain with respect to certain things like interest rates. We're not sure we're using the correct interest rate. So we use 90%. And again, here, it is clear that if the lessor, the owner, is capturing or recovering 90% of its investment, it's pretty clear that the lessee has absorbed most of the risks and rewards of that asset. Pretty much transferring the risk to the lessee. Okay. So those are the four conditions. And once again, if you want to avoid these bright lines, these are US GAAP bright lines, just make sure you don't cross them. Make sure there's no transfer of ownership, no bargain purchase option. Structure the lease without a bargain renewal or keep the lease term short. And then, of course, and by the way, companies have done this. There's always been an argument that companies have had agreements where they go from one short-term lease to another. So they lease it for 2 years and then another 2 years, and it might be the same asset. They just leave it or just keep it, and they avoid capitalization that way. So you can avoid capitalization, just make sure that you have not met any one of these four conditions. If you meet any one of the four, the asset is on balance sheet. If you don't meet any, it's an operating lease, and you have simple rent expense. Now, again, we have to look at certain problems, and we are going to look at problems to circle back here. I'm not going to do land because land real estate is kind of tricky. Last semester I put this on a video, so I have a video lecture on this if you're interested, but this is kind of a specialized area. But what I want to do now is go to page 10 and take a look at IFRS. And I want to compare it to the US GAAP standard. Now, let's make sure we put this in perspective once again. So when we look at US GAAP, and just a little bigger. When we look at US GAAP, we think of them as rules or bright lines. Sorry, let me bring that out a little bit. And IFRS as principles. So let's compare them. And as I said in the introduction today, that I think leasing is the best example of this. And we are going to move away from the bright lines. By bright lines, I mean you have quantitative cutoffs that can easily be avoided. And by the way, remember we said that we use the lower interest rate to keep the PV higher? We don't want to give the lessee the choice because it would lower the liability. What would happen also here if I used a high discount rate? It lowers the PV. It's more likely that you might fail the 90% test. So the lower interest rate avoids understating the liability, but it also avoids manipulating that 90% test. And that's why the FASB put that in. So once again, what I want to be sure is, yes, it's nice to know, and you could survive on a CPA exam by making sure that you use, or on one of my exams, I guess, unless it's an essay, that you use the lower of the two rates. But the reason for it is to make sure that we don't understate the liability, and we don't want to give the lessee the ability to have a lower PV by selecting the higher rate. The higher rate could lower the PV, and you might fail the 90% test. So that's why that check was put in by the FASB. Okay. Now, let's look carefully at IFRS. First of all, IFRS, always much easier. One set of rules for the lessor and the lessee. US GAAP, we still have to look at the lessor. Separate module for that. IFRS, very simple on the interest rate. Always use the implicit rate, always. Use the implicit rate, unless it's not available. So for the IFRS, the discount rate is always the rate implicit in the lease, unless it's not available. So same rules, lessor, lessee, implicit rate. Now, here we go. Let's look at the capitalization conditions. First two bullets are the same as US GAAP. Transfer of ownership would lead to the conclusion that you have a capital lease, bargain, purchase option, right? The lessee has the option to buy the asset at a value that's substantially below the fair value when the option becomes exercisable. So that first two criteria are the same. Now, here's the difference. When you look at the next two, sorry about that. Instead of the 75% test, they're saying the lease term is a major part of the economic life. And of course, land, by the way, we talked about real estate. I mean, you should know that real estate leases can't use the 75 or the 90% test. I mean, clearly, what's the economic life of land? It's infinite. You'll never, test is not operational. And the present value of the minimum lease payments is substantially all of the fair value of the asset versus 90%. Now, we are going to move to some of this terminology. So what I always talk about here is just to get your take on this for a minute. You know, in a lot of ways, I'm much more comfortable with US GAAP because I can calculate 90% or I can calculate 75%. When you look at IFRS, a little bit of a problem here. What are you going to do and I always use this example, what would you do if you're working for, you know, Ernst & Young or PwC? And in California, a lease is presented and the lease is failing all of the tests except that the lease term is 60% of the life of the asset. Is that a capital lease? Partner in New York gets the same lease. Is 60% a capital lease? Does PwC create a standard across all offices which now becomes another bright line? I'm not sure how it's going to work. And I know that in IFRS it's easier because there's less litigation in Europe than there is in the United States. so that it's a lot easier for them to make these judgments and have inconsistencies across regions and offices. I don't know if we're going to be able to do that in the U.S. I don't know if we're going to be permitted to have a local office make judgment with respect to whether or not the lease is capital or operating. Yeah.
Isn't the application of the act for IFRS the client and where they file, as opposed to being specific office of client?
Well, no, I'm saying if we go 100% IFRS, yeah, there'd be no choice at that point. Yeah, but you're right, because some clients obviously are a different jurisdiction. You could have a, obviously you could have a client in New York that has filings in different countries as well, right? Yep. Yeah, so, and what's happening, the new standard, I'm going to tell you, we don't use these as triggers for capitalization. We use them to change the accounting. So the new standard is going to pretty much capitalize all leases, but the way we account for that lease will change depending on whether it's a major part or substantially all. So we are going to use the term, but it's going to be applied a little bit differently. So right now, this is the standards we have for IFRS. Now, there are some others. A specialized asset, and I think we look at this under US GAAP as well, but it's not codified. If the asset is specialized and you're the only person that can really make use of it, then it's a capital lease. Other situations, you know, these two right here, where there are some losses and gains that are either absorbed by or rewarded to the lessee, make it like a capital lease, or if there are any penalties and those losses are absorbed by the lessee, or if there are any gains and losses from fluctuations in fair value, if that's built into the lease, and the lessee either benefits or has to suffer a loss on that change in fair value, that becomes a capital lease. And here's one that's different. If there is a bargain renewal option, a bargain renewal option triggers capitalization under IFRS where it doesn't under US GAAP. So again, it's more of the issue of having this as principles-based rather than rules-based. And as I said, the new standard will be harmonized. We're going to have the standards will be the same or very similar. And we are going to pretty much capitalize all leases, and the difference will be accounting for the depreciation and the interest. Yep. So. It'd be non-current. The lease, yeah. Yep, it'd be long-term asset. Oh, for 5 years? Still long-term. The asset's still long-term. Most of these leases are going to be more than 1 year. So, in fact, the new standard says that if the lease is 12 months or less, you have the option to capitalize or operating lease. But yeah, no, a 5-year lease, that would be a long-term asset on the building, if it's capitalized. Now, it may not, depending on how long, you know, whatever the structure is, if there's a transfer of ownership or bargain purchase option. But a 5-year lease typically for a building would probably be operating, I would think, right? Because unless there's a transfer of ownership or a bargain purchase option, there's really no way you pass the 75% test. Building might be a 40-year asset. A 5-year lease is not going to do it. And the present value, the minimum lease payments will be nowhere near the fair value of the building. Oh, if it's a transfer. Oh, yes. Okay. The new standard. Oh, yeah. So in the new standard, what you would do, yes, it would be long-term, and then it would become short-term for that one last year, right? Because it would become current. But yeah, you're going to, from what I've seen with the new standard, all leases go on the balance sheet. Now, for something like that, it's going to be interesting. They're, just very quickly, what they're doing is they're saying, all right, you're a lessee, you have to capitalize all your leases. And they clearly differentiate between property, which is building and land, and non-property. And if it's property, you don't basically have to worry about interest rate amortization. You don't have to worry about depreciation. What you do is you add the interest and depreciation together and debit rent expense. So it looks like an operating lease on your income statement, but a capital lease on your balance sheet. It's going to be very odd. I don't know if they're going to go through with this. This standard has changed its skin several times. Yeah. The transition. I haven't seen the transition yet. Haven't seen the transition. Or it's there. I haven't really focused on it. I'm looking more at the stand. But you're right. I personally don't think that they would they wouldn't go back and restructure those leases. When those leases ran out, they'd have to be anything would be under the new standard. But it's a real good question because they are clear. Your question is right on target. They are clearly differentiating between property and non-property. Just to take your question one step further, if it's non-property, it's generally going to be treated as I said, where you're going to package the rent expense, everything, all your expenses get packaged as rent expense. So your income statement looks like it's operating, but on your balance sheet, the asset and liability will be there, even if it's 5 years, even if it's 2 years. If, however, it's a property lease, but a really long-term property lease, using the term major part, then you would treat it as a regular capital lease with interest rate amortization and depreciation. So I think, I'm not sure if this one's going to get passed, but they're getting close. They have to decide on something. In fact, the notes that I printed before January are now gone on the update. So the new ones are up on Blackboard. Yeah.
How do they expect major part and substantially all next?
That's the question. I can't answer that. You're going to have some good reasons for it. I think it's going to take professional judgment, and it's going to be rough. I just think going to that might be tough. But the good thing is the transparency, so that it's a matter of what gets reported on the income statement, not the balance sheet. So the major part and substantially all are not going to drive capital versus operating on the balance sheet. It's only going to change the way we recognize income or expense. It's going to be the same total expense. So if, let's say, it's not a major part and not substantially all, asset and liability go on the balance sheet, but on the income statement, if it's not substantially all, not major part, everything gets wrapped into rent expense. So you add what would have been depreciation interest and call it rent expense. If it is substantially all or a major part, then you split and you have interest expense and depreciation. But the asset is still on the balance sheet no matter what. And the liability is going to still be on the balance sheet. So it's going to be interesting. I want to see how far they get with this one. As I said, they met on January 23rd, and the meeting basically said they're going to consider this latest version. What they do with it is going to depend on the next meeting. Okay. Now, let's go through a couple of examples. So I think it's time to sort of at least give you some illustrations. So let's go to page 11. We're going to try to circle back with some of the theory, some of the things we said today. And this is the way I'm going to present the material on a regular basis. I'm going to lay out theory, definitions, and then go back to some examples. These examples are not necessarily going to focus on the criteria for capitalization, just the effects on the financial statements. So, operating lease. Let's take this example. Let's assume that we have Berg Manufacturing deciding to lease a piece of equipment for use in its North American operations from this Borco Bank. It is a 10-year lease. The payments are $1,000 at the beginning of each year, and the machinery has a 20-year life. Depreciated on a straight line basis, no residual value. The PV of the minimum lease payments are less than 90%, so under these rules, you don't have a capital lease. No transfer of ownership, no bargain purchase option, and in fact, you fail the 75% test because the lease term is 10 years, but the asset has a 20-year life. So we know that's 50, so that's less than 75. So we know that that is not a capital lease. It's an operating lease, and let's see how you would account for it. On the day you sign the lease, nothing's done. You don't have any interest, no depreciation, but every year you make a payment that debits rent expense and credits cash. That is an operating lease. Asset and liability are not reported on the balance sheet. Now, technically speaking, I've seen some textbooks that say that you should be debiting prepaid rent here, and then at the end of the year make the adjustment. I'm just going to expense it. So no asset on the books, no liability on the books. You simply have rent expense. Now, changing one condition. Now go to the capital lease, and I'm going to say that it's a 10-year lease, but now I have a 10-year asset life. So now I obviously meet the 75% test. I got 100% here, right? So now it's going to be a capital lease. So I know I have that. Secondly, I tell you that the present value of the minimum lease payments are $6,500. And that's also equal to the fair value of that asset. So it's 100%, so I would capitalize. Now, this means that the asset has to be measured at the present value of the minimum lease payments, or fair value, whichever is lower. They're the same in this case. The discount rate is 11.2%. That rate is the implicit rate, and I'm telling you it's lower than the incremental borrowing rate. That's the implicit rate. You have to use the lower of the two. So in this case, you have to use the capitalization method. You have to have a capital lease. So here's what happens. Payments are due at the beginning of the year. Let's look at these two entries on the bottom of page 12. It tells you that at inception, I will debit the leased asset and credit a lease liability. I don't care, by the way, if you call the asset leased equipment. I just need to know it's a leased asset, and this can be lease liability. I'm not really worried about that. But on the day a lease is signed, you create an asset and a liability. And then at the beginning of the year, you make your first lease payment. Now, we're going to see this, and as I said, I'm not going to get into too much today on amortization tables, but realize that when you look at this lease liability, on the capital lease, the first payment comes off immediately. So let's say that's January 1st, that's January 1st. So one of the things you have to get used to with annuities in advance at the beginning of the year, payments come off immediately and there's no interest on that payment. So it's the same thing when you lease a car. Your first lease payment is principal, 100% principal. So there's no interest on that $5,500. There's no interest on that first payment. Now, hopefully we're going to have time to go over the cash flow statement, but I'm going to bother you with cash flow all semester long. What do I do with that first entry? Cash flow statement, what happens here? Got to do something, nothing on the statement, but it's a disclosure. So this will be from the cash flow statement. Yeah, you're right, nothing on the statement, but there's got to be disclosure. Significant non-cash significant non-cash investing and financing activity. Now, of course, in finance, if I was looking at this from the standpoint of a transactions analysis, the lease liability is a source of funds, source of cash, and the leased asset is a use of funds, but it zeroes out and it doesn't go on the cash flow statement. This payment, where does it show up on the cash flow statement? Operating, investing, or financing. If it's rent expense, it's operating. This is financing, paying off debt. Okay. And I'm going to try to do this throughout the semester just to make sure when we go back, hopefully we have a chance to review the statement itself as a capstone for the course, because there's lots of stuff on that statement, the cash flow statement, that relates to what we do. Okay. All right, now, questions on capital lease for the first, on the day you sign the lease. Asset and liability, this is lessee only, haven't even touched the lessor yet. Yeah.
What would the cash flow be for the rent expense?
Rent expense is operating. Yeah, if you go back here, good point. If you go back here, this cash flow right here is operating. That's operating. Okay. Okay. Now, at the end of the year, we have to accrue interest. And that interest, what I want you to be sure to notice is that when you have, and I'm going to go over this again with a table, but when you have amortization using an annuity in advance, the payment comes off first, so that only $5,500 is subject to interest. So the interest is $616. Debit interest expense, credit interest payable. Interest expense, of course, on the cash flow statement is part of what? Operating? Well, it should be financing, but it's operating. The interest payable is an add back increase, so it zeroes out, correct? But interest expense is part of operating under U.S. GAAP. Amortization, of course, is part of operating, but it's going to be an add back. And again, I'm using amortization. If you use depreciation, it's not going to bother me. I use amortization here because the asset is the right of use asset. It's really an intangible. Okay. I'm going to show you this in a second. I'll show you the statements, but interest expense is part of operating cash flow. Interest payable is an add back, the increase, so there's zero cash. And of course, the amortization is an expense, a non-cash, and we add that back as well. What I wanted you to notice, of course, is that on the income statement now, when you look at the income statement, you're going to find that in the early years, interest plus depreciation or amortization is higher than rent expense. So now let's go to those financial statements. And let's start with the income statement, and then I'll do the balance sheet. So on the bottom of page 13, we have the comparison. So that depreciation expense is $650, interest is $616, so that total expense under a capital lease is $1,266, but it's $1,000 under an operating lease. Now, this is a disadvantage for the capital lease based on net income. But what are other income measures that we use? I want to give a capital lease a little bit of a favorable advertisement here. What other measures of income do we use? Go back to chapter 4. Yeah, EBIT, earnings before interest and taxes. So if we did operating, and if we did capital, EBIT would be minus 1,000 for an operating lease, but for a capital lease, it would be minus 650 in this example. And what else? We also have EBITDA, where we add back depreciation and amortization. So capital lease does better with these statistics. So even though the fact that we're going to capitalize leases lowers net income, companies will be reporting higher EBIT and higher EBITDA if all leases become capital leases. Because what's going to happen, and Anthony, let me get back to your question, and even Sally, under the new standard, this lease won't exist. We're going to capitalize it, but if it's a lease where it's property, or the lease term is not substantially all of the asset's life, or the fair value is not represented by the 90% test kind of that we used to do, they call it substantially all now, what we would do is just add these together and then debit rent expense here. So we wouldn't have to break it up, but it would still have the same effect. Now on the balance sheet, if you look at the numbers, I mean, obviously, the only effect on the balance sheet for an operating lease is the cash outflow for $1,000. Capital lease gets a little tricky. First of all, there's a cash outflow of $1,000. Then the leased asset, of course, is depreciated. So that one I don't think is problematic. Anyone have any questions here? All right, so you've got your lease asset minus your depreciation. What becomes tricky is in here. And if you wanted to, technically, I wouldn't argue, sorry, let me get these numbers, I'm sorry about that. I wouldn't argue if you just made this 1,000, the current portion of long-term debt, but I decided to split this up between principal and interest. So next period, when you pay the $1,000, the principal will be reduced by $384, and the interest will be $616. And the way I get to $384 is just to take the interest out of the payment. It's just the effective interest amortization. That's the current portion of the long-term debt. So what happens, obviously, is that when you look at working capital gets eroded by the capital lease, right? Because your current liabilities are higher. On top of that, of course, the long-term debt is on your balance sheet, and the long-term debt is, of course, at 55 right now. It's at 55, but this is a reclassification. So you just basically reclass that. The 1,000 is the first payment, and the 384 is a reclass out of long-term into current. So on the balance sheet, when you capitalize, leased asset at net book value, and the liability is split between its current and its long-term portion. Any questions on the balance sheet? And that the effect should add up. The asset increase and the liability increase should, and equity should be the same. Incidentally, the retained earnings effect, let me just bring this up. I'm sorry? Oh, yes.
The interest payable represented for the entire year.
It's just for the next year coming up. Yeah, because what happened here is that you accrued the interest on December 31st, and that means the next payment you make on January 1, $1,000, $384 is principal, and $616 is interest.
Okay, so you're counting, yeah, so that was accrued
That's right, the prior, yeah.
prior year.
Yeah, that's right, yeah. Going forward, so, yeah, so the current, right.
Okay.
So what this means is that next year, January 1st, when you pay that $1,000, of that amount, you're going to be paying $616 of interest you accrued on December 31st here, and then $384 goes against the principal. Okay, and of course, if you look at the retained earnings, this all comes from the income statement. So the income statement is here, right? So we close out the income statement to retained earnings. So the 1266 goes from the income statement to the balance sheet, and the same thing's true here with the operating lease. Same idea. It's going to be closed out. Oops, sorry. You get the idea. There you go. All right. Okay. All right, so again, it's going to be moving from the income statement into the balance sheet. Okay. Any other questions on the financial statements? And again, this is what I mean by building this through an articulation worksheet. You could have done the same thing as well. All right, and finally, the last piece of this is the pre-tax cash flow. And this is the rent expense on the operating lease side. The operating lease has a $1,000 rent expense on the operating activities for the capital lease. Now remember, when you sign the lease, it is a significant non-cash investing and financing cash flow. So it has zero effect on the statement itself, but it will, in fact, be reported, and I don't have it here, but it's reported as a significant non-cash financing activity and investing activity. When you look at the capital lease, net income is reduced by 1266. Interest payable, increase in liabilities represent interest you didn't pay, added back. Amortization or depreciation gets added back, so there's zero operating cash flow effects, and of course everything comes to financing. Now, same cash flow, same tax, but notice here's another, I guess, endorsement for a capital lease, has higher operating cash flow. Right? Because the rent expense falls right through, reduces the cash by 1,000, but the capital lease has zero impact on operating cash flow. So operating cash flows, if you just look at this line item here, operating cash flows are higher for the capital lease. Okay, any questions on the statements themselves? Any questions on capital versus operating so far? Anything we looked at today? Some of the definitions. Again, just to sort of recap, just some of the, I guess, trigger points you have to think about. When you look at a problem, make sure that you look for, at least for now, when you look at U.S. GAAP, we're not going to spend too much time on IFRS except to show some of the similarities and differences. But for U.S. GAAP, you have to look at the four conditions: transfer of ownership, bargain purchase option. If you're looking at the 75% test, don't forget that a renewal option affects the lease term. 90% test, present value of minimum lease payments, use the lower interest rate, and make sure, again, on the essay questions, you know why. Why to use the lower rate? Avoid understating the liability, and in fact, could also avoid failing the 90% test. Remember, the lower the interest rate, the higher the PV, the more likely it is you pass the 90% test, and it raises the value of the liability. And then, of course, the asset value cannot exceed the fair value. So we generally capitalize at the present value of the minimum lease payment.